I think gold and Bitcoin are clearly international assets that can be held. But I think one's got to be realistic and face up to the fact the world has changed. And that change in the world is partly a function of China and partly a function of demographics. And the fact is that the West is bust. And, the reason that the UK goes through prime ministers every 2 years is simply the fact there's no money left. They can't fulfill an agenda, and they lose the confidence of their party. But that's the reality. And that's probably a fact across Europe as well.
Bitcoin could double and still close this year lower than today. That's Michael Howell's warning, and it's why investors are paying attention right now. Howell says he's still bullish on Bitcoin long term, but he's not letting anyone ignore market cycles. Cycles have no respect for long-term trends. He explains, so knowing where Bitcoin sits in its cycle is key to benefiting from growth. Even a massive multi-year rally doesn't rule out Bitcoin ending this year below today's price. That's the risk investors need to understand. Howell argues Bitcoin has matured into a macro asset, with its price tied to economic growth, real interest rates, and Fed policy, just like stocks and bonds. This bear market has brought a major shift in Fed expectations and rising real rates. If macro forces are in the driver's seat, Bitcoin's bottom could arrive when those forces turn around. Some analysts believe this cycle hasn't hit the deep capitulation lows of past bear markets, projecting price floors from $40,000 to $53,000. Howell also calls gold and Bitcoin essential international assets, ones investors can hold no matter what happens in any single country. But the world has changed, he says, driven by China's rising influence and long-term demographic shifts. China just posted a $125 billion trade surplus in June, its largest ever, with manufacturers dominating global markets like never before. That's Michael Howell's full take. Hit subscribe, join Bitcoin Frontier Hub, and let's build toward 1,000 together, one viewer at a time.
I think the first thing if you're bullish on Bitcoin, make no mistake, we're bullish on Bitcoin in the long term. But the point that I keep making is that cycles have no respect for trends. And you've got to understand where you are on the cycle to basically benefit from these long-term trends. And even if, Bitcoin goes up strongly over the next few years, it may still be lower by the year end than it is now. And that's really the risk that we want to try and understand. What I would be doing first off is looking at what happens to the gold market and whether this China effect in the near term is going to persist. Okay. Now, we know that the MOU has been likely torn up, and it may well be that China decides that it can't afford to press the gas pedal and get the economy restarted because there's no oil around. So they're going to have to go double down again and put the brake on. I don't know. We'll have to see how that pans out. That could be the case. But the other thing that's bubbling away in the background is what's happening in I know we're sort of straying into the macro space. So if you, given the fact that liquidity tends not to grow exponentially, tends to be more cyclical than exponential, you can see why you get these financial crises. Now, it would be a nice, thing to say that as the world moves on, you tend to get bigger and bigger financial crises. And you tend to get them more frequently. That's not always the case. I think you can see those tensions building and then being dissipated, at different times. You don't always, every subsequent crisis is not necessarily bigger, but they're certainly, they tend to have a fairly constant frequency. If you look at our liquidity cycle, for example, that liquidity cycle tends to move with an average frequency of about 5 to 6 years. Now, why is that? Why does it move with a 5 to 6 year cycle? The reason for that, and by the way, that's a big contrast to what people normally cite as a Bitcoin cycle, which is 4 years, which I don't believe there's a 4 year cycle in Bitcoin. I think there's a 5 to 6 year liquidity cycle. And my view is that liquidity cycle is dominating things like Bitcoin, gold, etc. Now, that 5 to 6 year cycle is occurring because the average maturity of debt in the world economy is about that tenor. It's about 5 to 6 years. And so what you're looking at is ultimately a debt refinancing cycle, as I've described. So I think that's why you get them. So there is a fairly constant frequency. I don't think cycles are becoming more shorter or more frequent. I think there's a fairly constant cycle, and you can see at different times, depending on the background, that those tensions are dissipated sometimes, and at other times they express themselves in a big crisis. So is the next crisis going to be bigger than 2008? I'm not sure. There's clearly a case for that, but it's very difficult to say at this time. It depends on the speed of response of policymakers. If you start to get cases where it's going to be very difficult for certain governments to fund themselves, let's go close to home with Britain. I mean, if you've got a socialist agenda, which allegedly you have, being written down in the UK now, I mean, bond vigilantes worldwide are not going to be wanting to fund this at existing interest rates. So, how are they going to try and get this stuff funded? Well, there's going to have to be directives to pension funds or wherever it may be to try and force them to put money into the UK. And that clearly is something which is going to constrain investors' ability to invest. So I would I would diversify. That's the best thing. I think gold and Bitcoin are clearly international assets that can be held. But I think one's got to be realistic and face up to the fact that the world has changed. And that change in the world is partly a function of China and partly a function of demographics. And the fact is that the West is bust. And, the reason that the UK goes through prime ministers every 2 years is simply the fact there's no money left. They can't fulfill an agenda, and they lose the confidence of their party. But that's the reality. And that's probably a fact across Europe as well.
Forget everything you know about the 4-year Bitcoin cycle. Michael Howell says a completely different clock is really driving the price. Howell's research shows the global liquidity cycle averages 5 to 6 years, not 4. He doesn't believe Bitcoin follows a true 4-year cycle at all. Instead, he says this longer liquidity cycle is the dominant force behind Bitcoin and gold. Right now, Howell says his model is signaling sluggishness in crypto prices that matches the recent slowdown in global liquidity growth. Here's why these matters. Bitcoin is the most liquidity-sensitive asset in public markets. Changes in global liquidity have historically caused far bigger moves in Bitcoin than in stocks, credit, or commodities. For every 1% change in global liquidity, Bitcoin has moved 7.6% over the following quarter. Nothing else reacts that hard. Howell adds an important nuance too. Both Bitcoin and global liquidity have grown massively since 2010, and part of that overlap simply reflects the fact that both trended higher over time. Correlation isn't always causation, and he wants investors to remember that. Still, the pattern is hard to ignore. If liquidity really is driving Bitcoin's biggest swings, that cycle could matter more than any calendar date. Let's get back to the interview.
So what that shows is the black line is the movements in global liquidity on a much higher frequency basis. So what that's doing is looking at 6-week changes. Now, you may well ask, well, why 6 weeks? And the reason is that basically is a small filter that gets rid of noise in the data, because looking at week-on-week changes would be hugely noisy. There'd be no signal there. And a 6-week change is basically getting rid of a lot of the noise. There's still noise in that, but most of it's disappeared. The orange line is looking at a basket of crypto. So we have this basket we call BES, which is essentially Bitcoin 60%, Ethereum 30%, and Solana 10%, as a sort of broad brush index of crypto. And again, that 6-week changes. The black data series has been advanced by 3 months, i.e. 13 weeks, so it's predictive. And that's the tracking that you get. Now, again, what you see is what you get. We've been using this, consistently for many years now, trying to predict what happens in crypto. The correlation over that period has been about 0.55, or actually higher than 0.55. So in other words, an R squared of about over 0.3, which is pretty good for any financial series. And it's latest data is basically showing, as you can see, this sort of sluggishness, if you like, in crypto prices, which is completely consistent with the fact that liquidity has slowed down. And what this is showing is the black line is a rate of change of liquidity through financial markets. So this is using data, goes all the way back to 1965. It's using data from about 90 economies worldwide. And for each country, we're looking at about 30 different data series. So it's a very comprehensive analysis of liquidity worldwide. And the black line, as I said, is measuring a rate of change of liquidity. So it's not a level. And when we say that liquidity has peaked, we're talking about the rate of change. We're not talking about the level of liquidity, just to be clear about that. Okay. Now, what we've put on top of that cycle is, on the top of the black line, is a sine wave, which, for those that are mathematically inclined, has been estimated using Fourier analysis. And that was done actually in year 2000, so 25, 26 years ago. And we haven't changed it since then. And we've just run that sine wave on.
Wow, it's been pretty accurate.
Yeah, what you see is what you get. So it either works or it doesn't, but it seems to be pretty good. And that analysis was our attempts some years ago to do this. An institution called the Foundation for the Study of Cycles in the US actually asked for our data last year, and they said they'd like to do a more thorough and rigorous analysis because they study cycles in depth, and they've got much better algorithms than we have. And they came away, looked at the data, and came back and said, yep, we find it 65 months too. It seems to be pretty standard and doesn't seem to have changed since you first estimated it. So that's kind of reassuring. And that's the movement of the cycle. What you see, as you noted, is that cycle peaked at the end of Q3 last year. It had previously bottomed in September of 2022. And that upswing in liquidity has clearly launched what we've also called the everything bubble. So that's been, an important factor in this story. And it looks as if, which is the less good news, is that cycle is going to bottom sometime probably in 2027 and probably the second half of 2027, if I'm honest. So, we may have some way to go yet. And that's really the problem that we face now.
Bitcoin could be entering into one of its most important phases, and the next few years may bring big opportunities for patient investors. While short-term prices can move up and down, the bigger picture is what matters most. Keep watching Bitcoin, global liquidity, and the economy because they all work together. The more you understand these trends, the better prepared you'll be for Bitcoin's next major move. Do you think Bitcoin will benefit from the next global liquidity cycle? Share your thoughts in the comments below. If you enjoy this video, don't forget to like, subscribe, and turn on the notification bell so you never miss our latest Bitcoin updates. Thanks for watching, and we'll see you in the next video.